2018 started out just great for companies and the investors that put money into them, with the US corporate tax rate slashed to 20%. But these last few months of 2018 have been bogged down by worries on trade, rates, the economy. That's led to anemic returns. The total return for Morningstar's broad market US stock index this year through mid-December was barely positive, a gain of less than 0.5%. Very few of the bond indexes that Morningstar also tracks have made a positive total return this year. So, investors and their advisors want to know what's in store for next year. What should they expect? And where should they be putting their money for 2019? We're putting those questions to our panel today, a panel of experts with expertise in bonds, in stocks, and economics. So thank you all for coming into our studios. Let's get right to it, shall we? Let's start, if we can, on just characterizing what we've seen in 2018 and where investors, what they've had as far as their experience.
I'd call it the year of reversals, right? We ended up through the end of September with the dollar strong, oil doing quite well, growth investors within the equity markets outperforming value, the U.S. moving along based on its own fundamentals at a pretty good clip, and the rest of the world correcting, and now all of a sudden, rather than the rest of the world catching up to the U.S. has caught up to the rest of the world. Values significantly outperformed growth. Oil prices have declined quite a bit, and the dollar has weakened. So it was a sharp reversal. And I think the two main issues out there are Fed policy and the comments that Powell made back just 2 months ago. And then obviously the trade issues that we're facing with China are the two big ones that caused that reversal.
Right. Well, let me actually add one more to your list there of those three. And maybe I can add in political instability, I guess I'd say. So if we take, let's say, those three on the table there, what do you guys think? Which one are we most concerned about heading into 2019, if we had to pick just one?
I agree that I think it's really rates to a large extent. It has much bigger impact on the economy, just given that you're repricing debt at much higher levels. I also think when you look at kind of what the Fed's dealing with, it's unprecedented territory, right? We're dealing not only with raising interest rates, but shrinking a balance sheet. And then doing that in a global economy where developed markets really are still on the start line, right? The gun went off, we're halfway around the track raising interest rates, and we look back and everyone's still at the start line and sitting at zero, and you have that additional pressure of the dollar. And then the last thing I'd highlight is that you're also dealing with, versus past cycles, very high sovereign debt levels. So we're sitting here with 21 trillion in the U.S. We can reverse back to what happened in 08 and 09, and I think the biggest influence on markets at that point in time were really sovereign debt issues. So if we start to head back to higher interest rates, it's a little bit of a difficult territory for us because the fastest growing component of our annual spending in the U.S. is actually interest expense. So it becomes a harder and harder story to tell, and we all know where it ends, right? We can look at Japan and see what happens when you spend as much money. They're a little encapsulated from the standpoint that they own all their own debt. We have a little bit more of an issue in trying to convince people to take on our debt. So I think that's why interest rates are really the story here. I think tariffs are very important, and I think we'll have a big impact, but I think interest rates really take precedent.
Right. Well, I mean, that's a lot on the plate, I think, for 2019. So let's get into what you think about 2019 as we look ahead into the year. So start us off and tell me also if you're looking at back half stuff of next year or if you're looking to front load some of the conversation. So Owen, we'll start with you on this one.
So I do think we get a bounce back. I think the market reaction was pretty severe in relation to how quickly it reversed from a pretty nice upward trend. And I think the fundamentals are still there for the market to do well. I think the Fed will, at some point in time, back off of these rate hikes in 2019. So I think a lot of people are starting to suggest that we're not going to see 3 rate hikes in 2019. Maybe it's 2, maybe it's 1, and then maybe it's a pause. And I think that pause is definitely going to be the case. So I think it's going to be positive for asset classes in the U.S. in general, and I think the earnings backdrop is still going to be positive year over year, not the 24% growth that Jake alluded to, but probably high single-digit type of earnings growth, which is more than supportive to push the equity market higher, and then valuation levels are at reasonable rates. And then the last component of it is just the fact that I don't think we really can afford higher interest rates. So I think at some point in time, you do have to back off, and you do have to try to get growth going. That's not only in our interest, but that's really a global issue in developed markets.
And when you say we, though, do you mean consumers, companies? Who do you mean exactly can't afford that?
I don't think the economy really can because of the issue around the size of the debt problem, the sovereign debt problem. We went from a technology bubble to a real estate bubble to a sovereign debt bubble. It's not easy to convince people to sell their technology stocks to put more margin in their account. Foreclose on a house is difficult to do, but convincing politicians to take a hard measure towards trying to reduce both entitlement programs and raise taxes, which is the answer. We know it's the answer, and eventually we'll get there, but there's no one near term that's going to run on that policy.
Okay, well, what about this? Can we say then, is it true that we feel that the bull market is going to die in 2019? And if we agree there, because I think we do, is it going to be a bear market? You know, where you see a drawback of 20% or more, if I can put it into that category. Thoughts?
I would highlight, you know, we're dealing with lower energy prices, right? So that's significant in relation to both the consumer and businesses from an input cost perspective. So I think 2019 is a little easier than 2018 from that regard. And then in addition to that, anyone that deals within foreign countries, the stronger dollar this year, especially beginning of the year, really did hamper growth. So I think those two things would be tailwinds in 2019. And then if we do start to see the Fed back off, I think that's a pretty significant event. And we get any type of trade resolution, I think we could be dealing with a much more positive market. I don't see kind of the downside, just given the fact that, you know, we're at very low unemployment rates. I know we all talk about the inverted yield curve, that we're getting there, that, you know, we have that situation on the short end of the yield curve, but if you look at the ISM manufacturing number, which is another great predictor of recessions, we're nowhere near seeing that dip below 50. So I really don't envision, I think it's going to be more of the emerging markets, international markets catching up and doing much better, just given how much they corrected in 2018 and having a much better 2019 than the US kind of continuing to decline going into 2019.
Sure. Well, and this is the time of year, I think, when obviously everyone is getting together their outlook for 2019. So as you review both yours and other people's, are you seeing anything that you really strongly disagree with? Maybe it's not just in one particular outlook, but maybe you're seeing something, Owen, where the market, you think in general, is sort of thinking about this incorrectly, that the thought leadership that's out there is wrong on something. So I want to posit that to you, because I think our audience would like to know if there's something that you disagree with that's out there, some kind of thing coming up on the horizon. Anything from you, Owen, on that front?
I think consensus is lining up. I mean, I think this correction, to Frank's point, has been pretty severe when you look at the size and the move, and even within industries, right? Utilities are by far the strongest performing sector in the last 3 months, and you have other sectors that are down over 10% over the last 3 months, quite a few of them. So I think, you know, consensus is probably right on target this time. I think the one caveat I'd put out there is that you don't know with Europe, it's just a hotbed of unrest. I mean, you see what's going on in France, we know what's going on in Italy, what's going on in England. So I think that's an area where, from a political perspective, we could see further issues arise, unforeseen issues, frankly, just given where they're headed politically, what their issues, what they're facing, the differences from country to country in terms of what they really want to see from a monetary policy standpoint. It's pretty easy here in the US. Think how complicated it is over there if you're sitting there in your Italy and you want to head in a very different direction than Germany. And even look at the difference since the recovery, right? Germany's done extremely well from an unemployment perspective. Italy's gone in the opposite direction since 2008. So how do you really mesh that together and come to some type of conclusion? So the area that I would highlight as one that probably will be more of an issue and probably add to the volatility I think everyone on the panel has been highlighting is really Europe.
Let's talk a little bit about some specifics within the market. We haven't gotten a chance to talk about sectors yet. So, you know, obviously on outlooks, people like to have some takeaway of something that you think would be, I don't want to say hot pick, because I tend to not think that's the greatest way to think about it. But, you know, going into 2019, what should someone come into at the beginning of the year, let's say, and would remain valuable for them at the end of the year? Any sectors that you like particularly?
I would say, you know, I think we're going to get a nice bounce back in the ones that have corrected the most. So if you look at industrials, energy, I think those will be the ones to some extent that do rebound. They're also two of the cheaper sectors. They're trading quite a bit below where the market multiple is. And then I think from a defensive standpoint, healthcare continues to perform. It's up over 10%. It's the strongest performing sector year to date in the S&P 500, and it has all the attributes you want. It's not overly expensive. It really beats to its own drum in relation to the fact that you're dealing with, in many cases, with product stories, and product stories. Doesn't matter what's happening in China from a trade perspective. If you're developing a new cancer drug, doesn't really matter in relation to where interest rates are headed. It's whether or not that drug works that's going to ultimately drive your stock price. So I think product stories relative to secular growth, relative to cyclical growth, take precedent in a type of environment that we're potentially heading into.
Right. I do want to talk a little bit about trade wars. Obviously, we've woven that into the conversation, but are you only paying attention to China, or are you also looking at the new NAFTA, for example? Is there something in Canada, is there something in Mexico that you're also paying attention to that I think perhaps then you would think that our investor audience would also want to pay attention to?
No, absolutely. I think it boils down to, to Jake's point about intellectual property theft and the benefit that China's had from that, building out industries that are pretty significant when you look at what they're going to do in semiconductors, what they're going to do in healthcare. And then the flip side of that, to what Frank brought up around companies coming out in the large cap space, they are talking about sourcing elsewhere and China losing out from that standpoint.
Moving to other Asian countries, for example.
Or moving back, a very small percentage moving back to the US, most moving elsewhere to low cost areas throughout Asia. So I think that is a real risk for China. So China's got to make the decision. You know, I've been doing this for over 30 years. We've yet to have a country move from the emerging markets to developed markets. And it's silly when we're talking about China being in the emerging market index when it's as large as it is, but there's certain boxes you have to check in order to make that move. And I think the ones are you have to abide by certain rules. And some of the rules are you don't steal intellectual property, you don't force companies to open up and co-own plants in your country. Right. So there's certain things I think that they're at the point now, frankly, I would be surprised if they don't just start to cave, because I think the benefit of caving is a lot greater in keeping all and sourcing a lot of that stuff within China, building plants in China versus what they lose. So they've already stole, I think, enough of intellectual property. We did it way back when we were a nascent country from many different areas in Europe. They're doing it today, but I think it's at the point now where it makes sense for them to put the gown on and walk down the aisle and receive the diploma and head into the developed world.
Right, and investors will be more confident to work with them if they do some of these things.
I think next to artificial intelligence, I think China becoming a developed country and having a true middle class is significant, because it's so large and so beneficial to the rest of the world. I mean, look at the auto sector in terms of what they've done there in relation to the number of autos that they actually are purchasing. So it can have a very, very big impact, but I think they have to accept the fact that there's certain rules that come with that. And I think, when you go back through history, you can understand why China feels the way that they do in relation to the Western world. But I think it's at a point in time now where probably if you just sat down and objectively said what makes the most sense, I think it makes a lot of sense for them to kind of move past what they've been doing and head towards the developed world.
Right, get that diploma, as you said. Okay. Well, I feel like we have many more things to talk about. We can't talk all day. But one thing that I wanted to know was a little bit more about this debate of, you hear investors trying to figure out if they should be more in bonds or they should be more in stocks. So do we come down on that in any one particular way at all to help our audience understand where they should go going into 2019? Owen, are you thinking the same things there, or are you sort of thinking there's one way up to good returns?
No, I wish I could disagree with Jake and say that equities are the place to be, but I think it makes a lot more sense today to be more balanced, even internationally, emerging markets, but also when you look at fixed income, it's a real return now. And when you look at the way the market has moved, it's telling you that most likely rates aren't headed much higher when you have utilities rallying as much as they have in the last 2.5 months. So I do think that having a diversified approach and really branching into other asset classes. I would be careful on probably credit on the tail end of the spectrum, just in relation to what we discussed here today. I think there could be some issues on the lower end of credit.
Leveraged loans have been called out by the Federal Reserve as having issues. Well, I think as we look to wrap up, what I'd like to posit in your mind then would just be one takeaway in our hours worth of conversation that we've had today for our audience. Just one thought, if you could narrow it down, just to keep in mind for their planning as far as investing for 2019. And Owen, maybe we'll start with you this time.
Sure. I think we've seen a little bit of panic in relation to when you look at flows within the mutual fund world on the equity side and money being pulled out. And I think that's the wrong tack to take. I think from an investment perspective, you have to have, to Jake's point, that long-term outlook and really commit to an allocation. So I think even though right now it looks like there's a tremendous amount of uncertainty, a lot of it is more macro-driven. Companies in general are in very good shape. I think Frank's brought this up multiple times. When you listen to any type of conference call, industries are in very good shape. We have a lot of debt on hand, but when you look at cash flow, it's quite strong. So I think just take a deep breath, take a look at kind of where we're headed in 2019, and I think things are going to turn up and be a lot more positive.